Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and I'm joined this week by Zach's very own Kevin Matras, who's our vice president and the editor of The Options Trader, but he's also Zach's in-house expert and guru, I would say, on stock screening. And that's what we're going to talk about today, obviously the market conditions, because it's pretty rocky out there, and Kevin's going to be here to share some of his best screening ideas. And then both he and I are going to share some stock picks we think might be good right now with these kind of market conditions. And they're not oil or energy stocks.
How about that?
Just putting that out there.
Good.
And I just wanted to cover, the last time you were on, we talked about movies and the stocks that you could buy, in the movie industry.
Right.
And we talked about Sylvester Stallone and Creed, the Rocky role. He did get nominated for the Golden Globe, and he won.
Right, it's about time.
I know. And now he has the Oscar nomination. Do you have any predictions?
I think it's going to be Leonardo DiCaprio. But
Well, he's in the other category.
Well, which one is Sylvester
He's in the
Stallone
supporting.
in for? Okay, all right, then it could be him.
Well, I do
Sylvester.
think that there's going to be a big Academy push. They like the nostalgic guys.
Yeah.
And he's, been around a long time, and it's a great performance.
Clearly, our podcast influenced the foreign press for the Golden Globe. So if we keep this going, I think we'll be able to influence him into an Oscar.
The Academy. Yeah,
this is all us.
Could be. Definitely.
Yes.
All right. So let's talk about what's happening on the stock market, because as everyone knows, we've started off real rocky this year, obviously. But that doesn't always mean that's how it's going to be for the entire year. I was looking at some stats, and the last time, this year's the worst start ever. Everybody's seen those headlines to the S&P 500.
Right.
But 2009 was the prior worst start ever. And it was down about a little over 6% in the same 10 days. And this was down 8%.
Okay.
But that year, we saw the market actually finish up, even though it finished down for, into March of that year, but it actually rebounded and finished up 25%. Now, I'm not saying, we're going to see some huge crazy rally or anything like that, but just because it starts off like this, again, there is, history of it not being
So hang on, maybe I
gloom.
missed it. So in 2009, you say it was down 6% in the first 10 days, but how did January finish?
January was bad. It was down like 8 something.
Okay. So so we're only halfway through January.
Right.
We are down 8% right now.
Yeah.
So hopefully we will bounce. But if we get more of the same, this is just going to be digging an even bigger hole for the start of 2016.
It is, but that's why I'm pointing out, like it did in 2009 as well, but that was a real bad hole.
Right.
And then it did rebound off of that to finish up considerably higher.
Well,
So,
I mean, long term, are you still bullish on the market?
I am in the second half of the year. That's what I said on the podcast for our first show, whether or not we were bullish or bearish. And I did think that we were going to get a downturn in the beginning of the year. And I didn't think this bad, but I did think we would get one.
Right.
And then we'll bottom out. And because the economy is not doing that badly in the United States, we would see a rebound once we had a new floor in valuations.
Right.
Things would be cheap.
It's the Chinese stock market that has been plunging recently, as well as the falling yuan that has really brought global growth concerns to the forefront.
Right.
And that really is what has been tanking the U.S. market. Now, I know there are some people who want to attribute the pullback in stocks to the falling oil prices, but I just cannot buy that argument, because last year the price of oil was more than cut in half, yet stocks were flat. So you can't say it's all oil's fault, because if it was oil's fault, the S&P should have been down a heck of a lot more, but the S&P actually eked out a small gain. Now, they are attributing the oil to the most recent pullback, and to some degree, I will say that there is at least a portion of responsibility, because now they're not just looking at the low oil, they're talking about, what's going to happen if there's bankruptcies and all of this stuff. But if you were to look at the net benefit, there is an overwhelming net benefit of low oil prices to the U.S. economy, which completely offsets the negative impact on the oil companies in the U.S.
Did you happen to see any of those pictures? They've been making their way around social media and on the news about that. One of the service stations in Upper Michigan, I think it was in the UP, where the gas is, I think, like 59 cents a gallon. It was up on the sign, and that's the lowest anyone's seen anywhere in the United States. But I'm even thinking, like, I remember in the late 90s, it got under $1 in many parts of the U.S.
Right.
And I mean, I could fill up my car for like $10. That has to be a net positive.
I don't know what the oil prices are. I don't do a lot of driving. I take cabs to work. So what is gas going for? It's like what?
Well, here in Chicago,
$1.80
it's fairly expensive because of our refinery issues. But nationwide, I think it's like $1.75.
Amazing.
Average.
Amazing.
And that's, cut in half.
Right.
That's all just going into my pocket, and I'm definitely noticing it.
And a couple of years ago, it was over $4.
Right.
So
that's what I'm saying.
Think of all the additional money that consumers have in their pocket and businesses have in their pocket just to be able to keep their lights on and run their businesses and machines and everything. It is a big benefit, and I know this benefit is finally going to ultimately show up in earnings eventually, and that I believe is going to be one of the great catalysts to be able to keep on pushing the stock market higher.
Now, I'm going to put you on the spot a little bit because we didn't talk about this, but we did get China GDP.
Okay.
And, people were like, oh, it wasn't that bad. Do you believe any of that data?
I mean, you have to take all of their data with a grain of salt, but I saw the headlines, right? They're like, oh, it's the worst GDP in 25 years. But they're growing at 6.9% or 6.8%. Yes. So, I mean, it's the envy of the world being able to grow that fast. Now, I don't know if those 10% numbers were ever truly 10%. So I'm sure that there is some kind of fudge factor in there, but 6.9%, I cannot consider that some horrible, spectacular collapse. I mean, their growth rate has been slowing very, very incrementally, but a 6.9% growth rate, I think, is fantastic. And it's probably going to continue to slow up a bit, but that's still pretty good. And I do not believe that that is the thing that pops the U.S. stock market. Not at all.
Okay.
By the
That's
way,
optimistic.
If you were to take a look at the State Street Investor Confidence Index, you can see that all of the major regions are above the 100 threshold. So I believe in aggregate, the index came out with a print of 108, but North America is up above that 100 print. Europe is up above the 100 print. Asia is up as well. So if you take a look at what professional investors are doing, they are adding risk to their portfolio, i.e. buying stocks. And it's because it really is the only way you're going to be able to get any kind of yield. And I must say, one of the reasons why I don't think that the stock market is going to roll over anytime soon is because if you were to look at the earnings yield on the S&P, the earnings yield is 6.2%, whereas the 10-year is right around 2%, 2.1 or something like that. In fact, it dipped below 2% last week. I've never seen the stock market roll over with an earnings yield above 6%. And when you have this 4-point spread between the 10-year and the S&P, I've just never seen it. This is going to have to narrow considerably in order for me to start believing that this is the beginning of the end. But I think this is just a pause before we end up making our ways to newer highs. So there could be a little bit more downside action, but ultimately I'm expecting a plus sign in front of the numbers at the end of 2016. So you and I are on the same page there.
Okay, but for the people who are listening who, are very nervous right now because it's been a while since we've had a big pullback like this. I want to say it was basically 2011 was the last time it was this strong in a short amount of time. That was pretty rocky back then. But yeah, so it's been a while. How do you stay calm even if you believe, we're going to bounce off and it'll get better in the second half of the year? How do you manage your emotions when all of this is swirling around?
Well, I mean, for one thing, I guess I do have this belief that this is just a pause in the larger bull trend. I mean, if I thought this was the beginning of a recession and the beginning of a much larger downtrend, I probably would be thinking a little bit differently, but I would absolutely not be panicking. One of the things that I do with my portfolio is I typically will run stop losses and trailing stops on all of my positions. So if I initiate a new position and I am down by 10%, instead of wringing my hands and reading more news stories and wondering, oh, what should I do, and tossing and turning at night, it's like I got in, I knew where I was going to go out, and if I was down 10%, that would to me tell me I'm wrong on my pick, and I'm just going to get out. And any stock where I've been down, 20%, 30%, or anybody's been down, a large percentage, they probably could have had the opportunity of pulling the plug at a much smaller, less painful level. And for me, I mean, if you pull the plug on a 10% loss, you only need to see an 11% gain to get that money back. But if you are stubborn, and you say to yourself, oh, I'm only taking a loss when I sell, and you just allow that thing to dig into your pocket, now you're down 20%, 30%, 50%. Eventually, you're going to have to call it quits because you just can't take it. So if you get out with a 50% loss, now you have to make a 100% gain on that money to get it back. And if you're so slick where you can pull out a 100% return out of your hat, why did you just get clobbered for 50%?
So having a plan, it sounds
have
like.
a plan, and don't get tied up with the news. And if you're watching CNBC, turn the volume down. That will make it all better.
Yeah. That's a good point you make, that if, you're having trouble sleeping at night or that kind of thing, then that's kind of telling you something that
Probably.
You should make changes.
Yeah. And, if you find your portfolio making just wild swings, you should really take a look and see if you are over allocated or over concentrated in any one industry, because in theory, all of your stocks should not be moving in the same direction. Some should be going up, some should be going down, some may get blasted, some may be doing fantastic. But if your portfolio is always moving in lockstep with every other stock that you have, you probably are over-concentrated in industries, and you need to be able to incorporate more diversification.
Okay, let's talk about the stock screening now, because that's what I always go to you for.
Okay.
And I know you have a couple screens that you run when things get like these kinds of market conditions.
Right. Well, I mean, the first thing I would say is, the screens that I am running now, these are screens that I generally run all the time. So, I mean, there are some bear market screens that I will pull out on special occasions or when the market's getting very rough. We'll talk about that in a bit. But there's a lot of common themes that I am using right now that I use all the time. And one screen that I've been using a lot, and I ended up looking at how good it did last year, I have this screen called TA and FA winners. And this is short for technical analysis and fundamental analysis winners. I wrote about it in my book, and it's also part of the Research Wizard program. But last year, even though the market was only up a few percent, this strategy showed a compounded return of 71.4%. That is pretty spectacular. The lights keep going off in here. It's like, what's happening? But one of the reasons why I like running this screen all the time is because I have back-tested this strategy over the last 16 years. I think I created this strategy maybe about 5 years ago. But over the last 16 years, it has shown an average annual return of over 51%. So last year's 71% return not only beat the market, but it also outperformed its average gain. So it's really doing well. And the reason why I focus on this one, and one of the reasons why I think it is doing so well too, is it looks at your typical common, fundamentals. It's looking at companies with a Zacks rank of a 1 or a 2. It has to have, industry-beating growth rates. It has to have low valuations. But one thing that I like looking at is I like looking at stocks that are exhibiting strength. Now, I know when the market is pulling back, a lot of people like beaten down stocks, and I think
That
that's
would
one
be
of the
me.
things you like.
Yeah.
And I can totally understand that because that is one of the hallmarks of a value investor.
Right.
For me, I am a big value type investor, believe it or not. But I like finding the stocks that are either making new highs or are trading within 10 or 20% of their 52-week highs or are basing near their highs because especially during difficult times like this, when it seems like all the stocks are going down, right? When the market's going up, 70% of stocks go up. When the market's going down, they say 70% of the stocks are going down. But when the market is going through periods of difficulty, I'm looking for the ones that are exhibiting strength because this shows buying demand. They're bucking the trend. Something is happening to keep these stocks supported at this level. So if you have stocks that are trading in the upper end of their ranges and they have very low valuations, that I believe is the best of both worlds and why I believe these types of screening strategies have performed so well in both up markets and down markets.
Are these Zacks 1s and 2s or?
Yeah,
tell
so for the TA and FA winners, that is Zacks rank 1s and 2s.
Okay. The buys.
Yeah, strong buys or buys. And that also is another common theme in a lot of my strategies. There's another strategy, for example, R squared growth rate. And I've recently pulled that one out because that one has historically done fantastic even during bear markets. Now, we are not in a bear market right now, but again, we have been going through a clear rough patch. And when I look at the R squared growth rate screen, that one in 2008 was actually up. It's a long screen.
Wow.
It was up 14% while the S&P was down 37%. So that just shows that it's finding quality companies really no matter what is happening in the market. Now, it's looking at the same kind of thing, stocks with a Zacks rank of a 1 or a 2. It's looking at a lot of the common fundamental metrics, and there is a price component in there also. The R-squared growth rate item, by the way, is looking for a trend line EPS growth numbers. But again, finding something that's one of the other common themes, like I said earlier, finding something or finding stocks that are being able to buck the broader market pullback. I believe that you have more money focused on fewer companies, which is exhibiting buying demand, and those are the ones that I think will see some of the greatest potential during these types of difficulties.
Okay, both of those screens are on Zacks Research Wizard, right?
Yeah.
Okay, but if you don't have that, I know that there's some free screens on just Zacks.com you can go to under screening, and then
Right.
it says stock screener. There's like 4 or 5 there. A couple that I kind of like. There was one that's based on 10% or more positive surprises. So that's
Okay.
just on the earnings beats.
Right.
But there's also one that's called solid growth and low valuations. And that uses, the basic things, but the PE, the PEG, and the price to sales ratio,
Right.
which I know is a favorite of
Right.
yours. But that's a good place to go to just start to look at some of these, already made screens. You just plug it in and
Right.
press run screen.
Right.
And then on Zacks Premium, where you have to be a member, we have 20 predefined screens on there. And that had a lot of more interesting ones that are a little more detailed, including one that's just upgrades and revisions. So that's just what's going on with the earnings analysts and the estimates.
Right.
Then they had one that we have a lot that are the number 1s or number 2s with the growth and value plugged in there. And then we have one that's just on PEG, which I kind of like.
Right.
So that's a good place to go to. If you're a Zacks Premium member, you can get all 20 of those screens. And I like to use those,
Right.
especially with these kind of market conditions.
Oh, they're fantastic.
Yeah.
The premium screens, they do give you the unfettered access to the Zacks rank 1s and 2s. But yeah, you were talking about some of those valuation items. And again, I think you and I may have slightly different styles of investing, but we both can appreciate the value characteristics.
Right.
When you were talking about price to sales, yeah, it is one of my favorite items. And I ran a study a long time ago, and it showed that companies with that had price to sales ratios of less than 1 by far outproduced all of the other price to sales ratios out there. Wasn't even close. And then when you added the Zacks rank of number 1 to it, your return skyrocketed even more. When I am looking for stocks to buy, I don't care what kind of environment we are in. And even though I do like to look at stocks that have good price action strength, not necessarily momentum style stocks, but stocks that are outperforming on a relative basis at the very least, I will always be looking for stuff that has low valuation metrics, because everything being equal, if you have a company with very low valuations, in theory, it has less to fall potentially than a company that has excessive valuations. And that actually leads me to one of the bearish screens that I have recently pulled out. Again, not in a bear market, but I think having some short selling opportunities in your portfolio is a good way to flesh it out and diversify yourself, because we could both be wrong, and at the end of the year, we may see a big negative print, although I don't think that's going to be the case. But when I'm looking at my bearish screens, and I have one called Toxic Stocks 2, I am looking for all of the opposite things you want to look at. But for one, I'm looking at companies that have a debt-to-equity ratio that is huge, twice as much as their industry. You're looking at companies that have downward earnings estimate revisions, and I'm looking at companies that have PE ratios of 50 or higher.
Wow.
And I would even throw in the price to sales ratio of 4 or higher, because once you start getting into the PE ratios of over 50, it's very hard to be able to find stocks that are going to see any kind of real sustainable run. When you look at companies with a price to sales ratio of greater than 4, more often than not, those companies in aggregate lose money over the course of, the next 3 to 6 months. So you want to figure out a way to tilt the odds of success in your favor. So for right now, I personally like looking at stocks that have a degree of strength. Find companies that have low valuations, and if you're looking for opportunities to short sell, find those companies that have downward earnings estimate revisions, and find the ones that have excessive valuations, because those are the ones that are probably going to get collapsed at the slightest hint of bad news, in my opinion.
Okay, that's a good tip. Now, what about the stocks? We brought a couple to recommend to people. I guess I'll start first. Going off of the theories we were just describing, I did find at least one that is being sold off right now. So it's not somewhere you can go and hide out and be safe. But I like it because it's cheap and there's no reason for it to sell off, but that's true of many stocks right now. But it's Lynette. The ticker is LCI. They do generic drugs. They are Zacks number 1. They have a PE, a forward PE of 8.6 now. They just recently acquired this company called Creamer's Urban. I don't know if I'm saying that right, but they basically doubled the size of their company. They're in other products that already Lynette was not in. So that's going to be really accretive to earnings this coming year. They're supposed to see a little bit over 20% earnings growth this year. So I like all the numbers, but no one else likes it. Stock is sold off. But if you're looking to get in now, I do like it here. And then my second one is a United Health Group. That's the ticker UNH. They just reported earnings. But they're one of the ones that I feel is holding up pretty well in these market conditions. They're in health insurance. They beat again when they just reported. They reaffirmed 2016 guidance. That's what I want out of a company right now with these kind of rocky conditions. And they're supposed to see 20% earnings growth in 2016. So that's somewhere you might be able to hide out right now.
Right. I like healthcare. I think all of those are good picks. As for LCI, I'm familiar with that stock. It's Zacks rank of a number 1. And their industry, if I'm not mistaken, Tracey, is in the top 18% of Zacks ranked industries. And that's always an important thing, because studies have shown that just being in the top 50% of industries outperforms the bottom 50% by a factor of more than 2 to 1. So you've already got the wind at your back on this one. I know that they have low debt to equity, but you says they just bought somebody.
They did.
And maybe that's why I'm looking at the projected sales growth, because the sales growth is over 49%.
Yeah.
So that is spectacular. And they have ridiculously huge margins. So I think it looks good. And again, going to your theme of trying to find companies that have been beaten down, I believe they've been beaten down by 18% in just the last month.
That's right.
So with all of those great fundamental things happening and the stock getting pummeled the way it is, this looks like a fantastic buy. So
Yeah.
I definitely would agree with that.
Okay. Now, what hidden gems have you brought?
Well, for one, Johnson & Johnson, that's one of the stocks I like. It's a big cap stock, so if you were looking for a place to kind of hide out, you could probably do so. I got into it for a different reason. First off, right now, there is Zacks rank of a number 3, so, no great shakes, but it is harder for a big, large cap company to get those coveted 1 or 2 ranks. But they are in the top 34%, so that's good. Low debt to equity, decent valuations, big margins. What put this on my radar screen is I had read a report that Johnson & Johnson and AbbVie's cancer drug Imbruvica showed significant benefits in treating leukemia recently, and I was thinking that this high-profile news would probably be enough to be able to start putting these big pharma companies on people's radar screen, because I still think that there's a lot more upside to go in the medical sector. That goes to your pick, that goes to this one, and they're going to be reporting earnings in a couple of weeks on January 26th, and I believe at that point we finally get past the century mark, and I think that we see a lot more good things happening. The other things that I've come up with, they have come through these screens that we had just got done talking about. One of them is American Water Works, that is ticker AWK, and they are the largest investor-owned U.S. water and wastewater utility company. There is Zacks rank of a number 3, once again, not a 1 or a 2, but they were when it originally came through my screen. But again, they're in the top 25% of Zacks ranked industries. But going back to my earlier theme, what I particularly liked about these guys is they have broken out of a bullish consolidation pattern not too long ago. They have held up very well in spite of this market sell-off. In the last 4 weeks, even though the market's been down considerably, this stock is still up 2.5%. Last week they were up 1.5%, and today alone they're up another 0.5%. So here
That's
you
really
have
outperforming.
Right. So it's a company that is exhibiting strength, and they are trading literally within 1% of their 52-week high. So if you're looking for something, you're looking across the market and you're bemoaning your misfortune.
Right.
Look at all these stocks going down. Here's, a beacon of hope. Here's a stock that's holding up and it's actually, trading near its highs. Another one I like that you and I both have in common is Orbital Atk. So I'm going to ask you what put it on your radar screen first.
Well, I originally owned it before they did the spinoff.
Okay.
So I owned it when it was just ATK. I think it was Alliant ATK. Okay. And I like the defense aspect of it because they do a lot of, military systems and missile systems and things like that. And then they split it off into 2 companies. One was the Orbital with the ticker OA, and then the other one was their ammunition and outdoor company, Vista Outdoors. And I actually still own both of those in my value investor portfolio. I didn't sell either one.
You're up in both of those, right?
Yeah.
So for me, I just got into this, I think 1 or 2 weeks ago, so I don't have that big cushion of profit that you have. But yes, you're probably still holding on to it because you are still expecting greater things.
Right.
And I'm getting into it because I believe there is at least a good 20% upside from here. But again, for me, seeing how this stock has held up during this recent sell-off has been very exciting. And when you take a look at all of the other common themes that we've been talking about, it's outperforming the market. The valuations are very nice. They have market-beating growth rates. In fact, they're projected to grow earnings by over 13%. So these are all things that you want to look at. And there is a way that you can beat this market, even if the market is not cooperating with you. If you just, put your head down and think to yourself, what are the characteristics I want my stocks to have? There's 10,000 stocks out there. You need a way to find the good ones. And there's plenty of ways to be able to reliably pick stocks that have a very high probability of going up, regardless of what's happening in the market. A lot of these reliable screens are on our site. There's plenty of other strategies on other sites as well, but don't settle for a stock just because you may be somewhat familiar with its name. Dig down and think to yourself, ideally, like what would I want my stock's characteristics to be? Put those into a screener. You will find a lot of fantastic gems. And instead of picking up the paper and reading about a stock that's up 60% and thinking to yourself, man, I would have been in it had I only known about it, you can find it by just doing a little bit of 5 or 10 minutes worth of screening, and you'll be amazed at how you can transform your portfolio.
Yeah, I think that's important to say because there's a lot of people who just go along with the big names, the glamour stocks, as I like to call them.
Right.
But there's so many mid-size and small cap companies that are kind of overlooked and, that are killing it in their business.
Right.
So
and you don't hear about it until after the fact.
That's right.
But you'll be able to discover a lot of those things. Look, once you start to see earnings estimate revisions moving up on a lot of these smaller name stocks that don't have a ton of following, now those things are immediately put on your radar screen. And then you're going to see professional investors jumping on those, institutional investors, and you yourself, and you'll be able to start putting these into your portfolio. Plus, too, the Googles and the once upon a time, the Microsofts or the Apples, these are all familiar names that have done spectacular, but there was a time where you never heard of these stocks in the first place.
That's right.
And now they're your favorite stocks, or at least they were when they were going up. But yeah, there's a lot of stocks that you have never heard of right now that if you just did, they will soon become your favorite stocks and they'll become some of your most familiar names. You just need to expand your horizon to figure out how to put these into your portfolio right now. And now is the time to do it.
Yeah, that's some great advice. I'm going to have you back on to talk about your favorite topic, that price to sales. We should go more into depth on that.
Yeah, as long as you promise that we're going to talk about movies again.
Well, we might have to. We might have to talk about Sylvester Stallone's Oscar win at that point.
Good.
Okay, so that covers this week's show. But remember, if you want to know more about any of these screening ideas, be sure to go to Zacks.com. There is a tab up at the top that says screening. And you can click on that. It has a stock screener in there. You can get some of the free screens, or if you're a Zacks member, you can get these premium defined screens. You can also get these more advanced screens on Zacks Research Wizard that Kevin was talking about. And if you want to read any of Kevin's excellent screening articles, those are also on Zacks.com, where he gives a lot of tips on how to, put together your screen and what are some good screening ideas over there. And be sure also, if you want to hear more of the podcast, if you want to listen to our discussion on the movies and the movie stocks, it's not out of date yet.
Right.
It's still relevant. You can check that out on soundcloud.com, or we're also on iTunes. So for this week, thank you, Kevin, for being on, and I'll see you again next time.
Thanks.